Well, good morning, everyone. Thank you for joining us today. My name is Jared Wise. I'm the Vice President of Marketing and Business Development with Your Better Business Bureau. I have with me Larry Pond. He is a CPA, among many other things, and he is a tax specialist, and we're very happy to have him with us today. He's also one of our board members. So we're happy to have you with us today, Larry. And we're going to talk today about how the new tax law will affect your small business. This is in our Skill Builder series. So Larry, thank you again for joining us today. Give us a little bit of background about a little bit of your background.
Okay, Jared. Well, thank you, everybody, and good morning. And today we're going to talk about the new tax law known as the Tax Cuts and Jobs Act, and specifically on the impact on small business. A little bit about me. I've been a member of the Better Business Board of Directors for over 20 years now.
Nice.
And I have a CPA practice in Redwood Shores, California, where I help clients reach their financial goals.
That's great.
Tax planning and tax representation and helping them figure out all the different life transitions we go through. And many of our clients have small businesses, and there's a lot of changes that are being made by the new tax law. So we're not going to do a recap of the tax law, of the new tax law. We're not going to delve into the areas related to individual taxes. We'll do that in a subsequent webinar.
Perfect.
All right.
And so we'll give a little bit of background about BBB, but if you have any questions as we go along, because Larry has some great information to share, and I'm sure you will, make sure to put them in the box on the right-hand side of your screen, and we will answer them at the end of our webinar today, which should last about 45 minutes or so, give or take a few minutes. But if you don't know anything about BBB, which I hope you do, because you should be an accredited business with us, let me see if I can switch through here on my slides. There we go, bam. I'm going to give you a little background about BBB, so who we are. So BBB helps people find and recommend businesses, brands, and charities they can trust. BBB is an unbiased nonprofit organization. As you can see, where we're located on the left-hand side of your screen, we are pretty much most of the Bay Area, and we go up the coast all the way to Oregon, as you can see right there. How people describe us: helpful, valuable, and of course, the main word, trust and trustworthy. And of course, our mission is to be the leader in advancing marketplace trust, and our vision is an ethical marketplace where buyers and sellers trust each other. And Larry knows all this too. All right, so now what you have all been waiting for, I'm going to turn it over to Larry, and he's going to give you some great information about the new tax law and how it affects your business.
All right,
Larry.
so today we're going to be talking about the new corporate tax rates. A lot of you are interested in this new pass-through business deduction. We'll talk a little bit about that. The new bonus depreciation, 179 expensing, the changes in the business tax deductions, and we'll close with some tax planning considerations.
Excellent.
So let's get started with the corporate tax rates.
Perfect.
So under the new tax law, they've simplified the corporate tax rate. It's a flat 21% tax starting in 2018. There's some special rules for businesses that are fiscal year. So there's like a blended rate if you're a fiscal year. But if you're a calendar year starting in January 1, 2018, your corporate tax rate will be a flat 21%. And that's different than the old law. The old law was a number of different graduated rates with a maximum rate of 35%. But frankly, very few corporations pay that hybrid rate. Most pay a much lower effective rate. This tax reduction is permanent. Unlike individual rates. Individual rates have been cut, but they'll pop back up in 2026.
Okay.
Now, this only applies to what's known as C corporations, regular corporations. So this does not apply to S corporations or LLCs.
Okay.
So for many of my clients, are small businesses. So most of them have been in the 15% tax bracket. So unfortunately, for many of my clients, they might be paying a slightly higher corporate tax.
Okay. Awesome.
So there's been changes in what's called the dividends received deduction. So if your corporation owns stock in other companies, you don't pay tax on 100% of the dividends you receive. Under the old law, you had a 70% deduction, and under the new law, the dividends received deduction is 50%. Next slide.
Okay.
Okay, next slide. Now, If your corporation owns 20% or more of another corporation paying a dividend, the dividends received deduction is now 65%. That was 80%. And this reduction in the deduction was a way of Congress paying for the cut in corporate tax rates.
Okay.
In the goal of simplifying the taxes, the corporate AMT has been permanently repealed. Unlike the individual AMT, that is still in place. So AMT stands for the alternative minimum tax.
I was about to ask that.
Yeah, so what that means is that it's a second tax system where you recalculate the tax and you pay whichever's higher.
Okay.
Well, we don't have to do that anymore for corporations.
Okay.
That's been repealed. All right, so there's this new deduction that Congress added. It's called the pass-through business income deduction. So if you're an individual, you have a business through a pass-through, such as you're a sole proprietor, you're an LLC, a partnership, or an S corporation, those taxes are paid at the individual tax rates. So to bring some parity with the corporate tax cut, Congress added this 20% business income deduction.
Okay.
And it's effective for tax years 2018 to 2025. So for example, if you're in the top 37% individual tax rate, the tax rate in your business is going to be 29.6%. So let's give a simple example here. Let's say you have a business, your business had $100,000 of income. So instead of paying taxes on $100,000, you pay taxes on $80,000.
Okay.
So you get a reduction in that. And that's a real big deal.
And apologize for any noise you might hear. We have construction going outside our building today, so just FYI. So sorry for the interruption on that.
Yeah, the building's going to fall down.
Yeah.
Okay. Anyway, so next slide. So there are limitations, though. So if you have income exceeding certain thresholds, deduction may be limited or phased out altogether, depending on two broad factors. So if your income exceeds a certain amount, which we'll show in a subsequent slide, the deduction is limited to 50% of the W-2 wages that you report in the business, or 25% of the W-2 wages plus 2.5% of the value of qualifying depreciable property held and used by the business to produce income. So let's talk about the second one here, because those words sound a bit confusing, right? So what's a good example of a qualified depreciable property? I have a rental property. Let's say it's an office building or something like that. So if we paid $2.5 million for it, so we get to deduct 2.5% of that $1 million plus 25% of the wages. So if it's more than 20%, if it comes out to be more than 20%, you get the 20% deduction. If you do the math, it comes out to be less than 20%. Let's say it's 15%. Instead of a 20% deduction, we get a 15% deduction. So that's what those two parts are. It's going to be complicated, and we're looking forward to seeing how the IRS is going to design the tax form to do this calculation. And that'll be sometime in the fall. So so that's a bit of areas of complexity. So this deduction is not allowed for certain service professionals. And so here's the list on the screen here. And so so they include health, which are doctors, dentists, orthodontists, healthcare professionals, law, lawyers, accounting, people like me, people do tax returns, accountants, actuarial science, performing arts, those are our actors and performers, singers, consulting, that's a very broad category, a lot of our clients are doing consulting, athletics, professional sports people, football players, baseball players. So if they set themselves up as a pass-through entity, they'll be limited because they're in that category.
Like the Giants.
Like the Giants. Right? Financial services, that's your financial advisor, your investment advisor, those sorts of people. So the last one is the very controversial one where there's a lot of questions. Or any trade or business where the principal asset of such trade or business is the reputation or skill of one or more of its employees. What does that mean, right? Well, a good example would be if I had a restaurant, and it's a regular restaurant, no one knows who I am. It's it's like this wonderful full restaurant next door here,
Yeah.
and you go there. Well, they'll get that 20% deduction. Not a problem, right? However, they hire a celebrity chef. Well, then they're going to be limited because it's this final category. So it's going to be very interesting.
Interesting.
Interior designer, that's also in that category. So some things to consider here. So here's an example. Let's say you're a lawyer. That's what you are as a profession. But you're not really providing legal services. You're not working on a law firm or something like that. You just happen to be working for a business that's not in this category. Then that's not limited.
Okay.
So there's a lot of interesting questions about. So we'll have to do some deeper study of your situation to see if you are going to be limited or not.
Nice.
So take a look at this list here. Go back to our list.
Oh, sorry, I was moving too quick.
And which two professions are not on this list? Well, for some reason, they might have a very good lobby or something, but architects and engineers are not on this list. They are specifically exempt from this limitation. So if you're an architect or engineer, that's very good. So for one of my clients, for many years, we've been putting consulting on his tax return as his profession because it didn't really matter. Well, this year we changed it to engineer because he is providing engineering services. So we're trying to take a look at that. I have many architects, so there really are architects, but there are people who have architectural backgrounds who really aren't doing architectural work.
Oh.
Yeah. So we have to take a look at the work they're doing to see if they qualify for this deduction or not.
Interesting.
Yeah, it's a big topic. There are actually books on this right now. So
wow.
We're talking about 1,000-page books.
Okay.
Just on this one very topic.
Wow.
So basically, if your taxable income is less than $157,500 or $315,000 if you're married, those limitations don't apply. So if your income is below these amounts, you get that 20% pass-through income deduction. So, but there's something called a phase out. You get a partial deduction. So if your income's between $157,500 and $207,500, you don't get the full 20%. You get a percentage of that.
Okay.
If you're married, it's $315 to $415, where you get the partial deduction. So what kind of tax plan can we do here? So let's say you're single and you're, let's say your income's at $175,000.
Okay.
Or something like that, but you want this full deduction. So this is where some tax planning can come into play. Let's try to reduce your taxable income. So easy way of reducing your taxable income is funding a retirement plan, putting money into a SEP, a solo 401k, a simple IRA, or whatever. We need to review which retirement plan is appropriate, but that can make a difference in qualifying for this deduction or not. Also, or also on your itemized deductions. Maybe I want to give more to charity. They'll help reduce my taxable income. So there's all kinds of planning that comes into play here to take full advantage of these. So we have to take a look at the big picture, and I want to emphasize the importance of tax planning.
Nice.
Yeah. So of course we don't want to deal with this when you're doing the tax return. We got to deal with it before you do the tax return. Okay. So let's talk about bonus depreciation. So bonus depreciation has been enhanced. It's now 100% from what it was at 50%. And this is one of the few retroactive tax changes in the new law. So for property that you put in service between September 27th of 2017, but before January 1 of 2023, you qualify for this 100% bonus deduction. Now, that's extended another year if you have some huge, bigger property, longer production period property, and aircraft, certain aircraft.
Okay.
And the other change now is that you can use used property because there's a large market of used equipment out there. The tractors and all those things. So before, under the old law, the bonus depreciation only applied to new property because they were trying to encourage production, but there's a lot of used property out there. Yeah. So basically, when you are buying equipment for your business, generally you have to recover it over time, known as depreciation. So bonus depreciation allows you to take a upfront deduction when you place it in service. So so that's what's so special about that. All right. So basically, anything after September 27th of 2017, 100% of the basis can be deducted in the first year it's placed in service. Okay, next slide. Now, this goes all the way to 2022.
Okay.
And then starting in 2023, this 100% is reduced 20% every year. So 80% in 2023, 60% in 2024, 40% in 2025, and 20% in 2026. Now, the timelines and percentages are a little bit different for aircraft and property with longer production periods.
Okay.
We can always look that up. All right. So let's talk about cars. So the cap on depreciation for business use vehicles has been increased to $10,000 for the first year. Under the old law, it's $3,160. $16,000 for the second year, up from $5,100.
Okay.
$9,600 for the third year, up from $3,050, and $5,760 for each subsequent year, which is up from $1,875 until the costs are fully recovered. So we can take a bigger depreciation deduction for business use cars now. Yeah. All right, we have this thing called Section 179 expensing, and what that means is instead of depreciating your property, you can take a 179 expense. So that's been enhanced because under the old law, the limit was $500,000 of equipment that you're buying. Okay. Now it's $1 million. And they raised the threshold for businesses up to $25 million. So for most of our clients, we're not going to have any limits on this.
Okay.
Yeah. So you know, I mean, the bonus depreciation, the 179, have some slightly different rules to them. So we have to evaluate, should I do the 179 expensing or should I take the bonus depreciation? And the answer is going to depend on your business situation, your circumstances, and your plans and all that. And we take a look at that. But also, it's been expanded to have more property eligible. You know.
Okay.
Yeah.
Great.
So it's encouraged corporate buying of equipment.
Nice.
Yeah. So let's talk about business deductions and credits. What's been eliminated? What's been added? So one of the deductions that were added a few years ago is known as the domestic production activities deduction. So you got a deduction for if you're producing goods in America, and you get a deduction for that. So many of our clients manufacture, and they took advantage of that. It was unfortunately a very complex calculation. So they've eliminated that deduction.
Okay.
During the tax debate, Congress was looking at eliminating what's called like-kind exchanges, also known as 1031 exchanges. But it's been retained for real estate. So the example would be instead of paying taxes on selling a piece of real estate, you can exchange it for another property of equal or greater value. That's been retained in the new law, so that didn't go away. However, for non-real property, that's gone.
Okay.
So examples of that would be airplanes. An airplane can be sold for quite a bit of money. By the time the airplane's being sold, it's fully depreciated, so it's all gain.
Okay.
So most planes are exchanged with 1031 exchanges. So unfortunately, that's gone. Computer storage is another big asset item that falls in this category. So it'll be interesting to see how that's going to affect future investments. We'll see how that all going to play. But that's one thing that's eliminated. One thing that did not got eliminated was the research and development credit. That's still in place. However, now there's a 5-year amortization of the research and development expenses, which means you have to, instead of getting a full deduction of those costs, you have to amortize them over 5 years. But you still get the credit.
Okay.
Now, there's a new credit, which we're going to talk about in a later slide, on a temporary credit for employers paying for employees on family and medical leave.
Okay.
So we'll talk about that in a later slide. All right. Let's talk about business deductions and credit. More business deductions. So some of the employers' deductions have been limited. So there's no more deductions for entertainment expenses. So that's gone. So we hear the term T&E. E is gone, or M&E, meals and entertainment. E is gone, and there's some questions about what that really means. So that's on the IRS guidance list. The tax professionals have asked IRS to give us guidance on what this means, because we don't know. For example, if I take a client to a ball game, okay, I can't deduct the ball game anymore, but I buy a meal there, can I still deduct a meal? There's some controversy of whether that's deductible or not. So that's a good question. So entertainment's not there, but there's a meal component. Can we still deduct that? So we need a little bit more guidance on that because it's a brand new law. So we don't know what Congress meant by that.
So it's probably not a good idea to take too many trips to the Giants game or whatever, expecting you're going to get a deduction from that.
Yeah, or buying those season tickets and writing it off as a business expense, right?
Got it.
Which many of our clients do that. So I mean, because they do, especially when you have a box. So there's a lot of controversy. Yeah, if I have a box, that's a place where we have meals and a private place to meet.
Good point.
But so we have some unanswered questions.
Okay.
So we need to figure out what that means. But I think we can use some common sense to figure out that, okay, if I just go to the football game, sitting in regular seats, okay, those tickets are probably not deductible. But maybe I can still deduct those hot dogs and fries.
Okay.
So those are
which are super expensive.
Exactly. Yeah. So no deduction for business meals, including the in-house cafeteria. So a lot of employers provide meals to their employees. So that's a good question. And then also there's no deduction for employee transportation fringe benefits either. But the compromise that they reached was that those benefits are not included in the employee's taxable income. So you won't see that on a W-2 now. Yeah. So if even though I'm not paying for the meal, they're providing me a meal, but I'm not paying taxes on that right now. That's the way it is. But if I am for the convenience of the employer, I'm requiring you to stay here to eat your meals and all that, that's still deductible. Okay. Until 12/31/2025.
Okay.
So that's what the law says here. And so there's been some recent cases about that.
Okay.
About good examples would be we're in the middle of an important project and you can't leave the premises. You got to get this done. We got this deadline. The clock is ticking. Okay. Those meals are not taxable.
Got it. Okay.
It's for the convenience of the employer, not for the convenience of the employee.
Got it. Okay.
All right. So business interest deductions. So as a way of paying for the lower corporate tax rate, Congress has figured one way of paying for it is to reduce the amount that a business can deduct for interest expenses. So a lot of corporations have bonds or loans and all that. So basically the limit is 30% of adjusted taxable income. But for most of our small businesses, probably not going to be relevant because small businesses are exempt from this limitation as long as your adjusted gross receipts is less than $25 million. So I think for most of our members, it's probably not going to
accredited businesses. Yeah.
Well, maybe you do have some more than 25 million. That's okay. For real property, if you're in real estate is obviously a very leveraged industry and asset. And if your gross receipts is more than 25 million, which means you collect more than $25 million of rent, then this limitation would apply. Unless you elect out this provision by using the ADS method of depreciation, which is a slower method than the modified accelerated cost recovery, MAKER's depreciation. So again, we need to do some planning to see if it makes sense to consider this or not. So,
okay.
And we got to do some planning to see if any of these, and what the impact of these changes are going to be to the business.
Okay.
All right. For employees, if you're incurring expenses at work, unreimbursed employee expenses, bad news, I'm sorry. That deduction has been eliminated. No more deduction for miscellaneous expenses. So that includes the unreimbursed employee expenses, travel, meals and entertainment, union dues, uniforms, subscriptions, safe deposit boxes, tax preparation fees, investment advisory fees, auto expenses. You know, a lot of people drive around on behalf of their employer. That deduction's gone.
Wow.
So you know, what does that mean? Well, probably we need to negotiate with the employer about, you know, their reimbursement policy.
Got it.
You know, so I mean, if you are incurring expenses on behalf of the employer, you know, so there's some discussions that need to be made about that.
Sure.
Right?
Yeah. It's a big one.
Another big deduction that's gone is moving expenses. So no more moving expenses. So, you know, you have to relocate because of a job. That's a big deal in this economy, right? Unfortunately, we lost that deduction. And I talked to recruiters about this, and they're not happy about that. Also, what that means is if the employer reimburses you for your moving expenses, that's now taxable. That used to be tax-free.
Wow.
But now it's taxable. The only exception is unless you're in the military.
Okay.
If you're moving while you're in the military, then that's still deductible.
Wow.
Yeah.
Yeah, that's a big one right there.
Yeah, exactly. So for our K-12 educators, you can still deduct up to $250 of your expenses you incur for your classroom supplies and those kind of things.
Okay.
Yay. So we still have that.
Good.
All right. So let's talk about this new credit, the employer paid family and medical leave. So it's a temporary credit. It's from January 1 of 18 to December 31 of 19. And it's a new credit for employer paid family and medical leave. So businesses can claim a general business credit equal to 12.5% of the wages paid to qualifying employees during any period in which such employees are on family and medical leave, if the rate of payment is 50% of the wages normally paid to an employee. And this credit is increased by 0.25% percentage points, not to exceed 25%, for each percentage point by which the rate of payment exceeds 50%. And all qualifying full-time employees have to be given at least 2 weeks of annual paid FMLA. So,
wow.
So that could be a big deal. And again, we need to do some analysis to see what this is worth to our clients.
Sure.
Right. But I think it helps alleviate some of the stress related to these type of issues. All right, let's close with some tax planning considerations. So although there's been a lot of changes in the tax law, most changes we've had in over 30 years. So, and actually we have a tax bill, right? So, but however, a lot of things have not changed also. So we have to put this into our tax planning. So the first thing is retirement plans. We talked about that earlier in terms of qualifying for that pass-through deduction. And if you're possibly limited because of your taxable income, we can take a look at retirement plans, which would apply to you. You have the SEP, Simplified Employee Pension, you have the 401k plans, and the simple plans. Each type of plan has its different set of rules, different sets of complexities, and pros and cons. And so we have to evaluate your situation to see which one makes the most sense for you. But it's a great, easy way of reducing your taxes. It's what's called an above-the-line deduction. So it reduces your adjusted gross income. So it's very important to consider. And also, there's timing issues, too, of when to fund them, when to open them, and those sorts of things. And we could do another webinar just on retirement plans.
That would be great.
Yeah, because there's a lot of them. A lot of choices, and we can talk about the pros and cons of each one and help figure out which one might make the most sense.
That's great.
So
no, I mean, Larry, I mean, this is great information. I know that new tax law is probably a beast, so it's like there's a lot of elements with it, and you did a really good job of explaining it too. What would you say is probably the biggest impact that small business owners will notice in this?
Well, that's a good transition to the next point here. Estimated taxes, right?
Oops, not social media, you know. That's not
estimated taxes, right?
Okay.
So those rules haven't changed in terms of how much I should pay for my estimated taxes.
Okay.
So the what's called a safe harbor thresholds are still the same. You either pay 100% of last year's tax, or 110% if your income is over $150,000, or 90% of this year's tax, whichever is lower.
Okay.
So there's a good chance that if your income is about the same, or even higher, your 2018 taxes might be lower than your 2017 taxes. And you have to have at least 90% paid in to avoid a penalty.
Huh.
So that's an important consideration because taxes are part of our cash flow planning, right?
Got it. Yeah.
So that's something to consider because of the new tax law. We might be paying less. So we have to see how these all impact you. Paying less because of the lower tax rates, paying less because of the business income deduction. For many of my clients, paying less because on the individual level, they're not paying AMT anymore, or they're not paying alternative minimum tax. So that makes a big difference. On the individual side, we have the new child tax credit, which is $2,000 per child. And so for many people, that can actually reduce their tax bill.
Wow.
So next point is withholding. If you're an employee and if you notice your recent paycheck, take a look at your most recent paycheck and take a look at your January paycheck. Same income, you might notice that the check's a little bit bigger because the IRS has updated withholding tables for the new tax law.
Okay.
However, that extra take-home pay you're getting might not be the right amount. It might not be equal to your tax cut. So for example, I was looking at this person's pay stub, and I noticed her take-home pay is $200 more per check now. So $200 more per check. So 200 times 24 paychecks in a year, right? She's paid someone monthly. That's what, $4,800.
Yeah.
Did I do my math right? Yeah, $4,800.
Yeah. So,
Okay.
That's what I'm trying to calculate.
But I did her math. Her tax cut's not $4,800. Her tax cut was $1,000. So the risk is tax time next year, she might be owing money.
Interesting.
So it's not really a tax cut, So we got to review your withholding because you might be claiming a single two, which worked just fine under the old law, but under the new law, would that work for you under the new law? I don't know. So we need to review your withholding to make sure you're withholding enough.
It's probably a good idea for employees not to go out and spend all that extra money right away either.
Because they might need to pay it back.
Yeah, because especially for this first year until they get kind of a footing on figuring out how that works.
So the other hot topic for small business is choice of entity. I'm starting a business. Should I be an LLC? Should I be a corporation? Should I be a C corporation, an S corporation? Should I be a sole proprietor? Each has its pros and cons. So that's a really important decision. That could be another webinar, but that's another decision. State tax planning. So under the new tax law, individuals can only deduct up to $10,000 of their state and local taxes, which includes property tax, state income tax. And so one bit of planning that we can consider is, well, maybe a chunk of your state income tax is because of income from your business. Well, for businesses, they still get the full deduction for state income taxes. Maybe we have the corporation paid instead of you. So that could be some planning to consider.
Yeah.
Again, this could be another webinar.
You have a lot of information.
We have a lot of information. The last point I'm going to bring up is, you might sell your business. And so we need to make some decisions up front to pick the right type of entity if you're going to sell your business. And we're not going to go into detail today, but there's a code section called IRC 1202 for QSBS, Qualified Small Business Stock. And if done correctly, you can exclude, I think, up to $10 million of capital gains from taxes.
Okay.
It's a big deal.
Interesting.
So there's some planning that goes into that. So,
that's great.
But these are just some tax plan considerations, and we can go into a little more detail later.
Well put together. You did a really good job. It's great information. If anybody has any questions, I noticed one that popped in, but if anybody has any additional questions, go ahead and start filling that in on the right-hand side of your screen, and we'll ask them live to Larry right now. I also want to show you our social media channels. Of course, you follow us. Larry, are you following our social media channels? He's looking. maybe not. Okay, but make sure to follow our social media channels. We're on Facebook, we're on Instagram, we're on Twitter, we're on Pinterest. The little ghost guys, our Snapchat. We're on LinkedIn, especially if you're a business, one of our ABs, make sure you're following us on LinkedIn. A lot of good business information on that page. And our YouTube channel. And actually, our YouTube channel, we're going to be hosting this recording on our YouTube page. It'll be about 3 levels down, but there's a whole series of our skill builders webinars that are recorded there, and Larry's webinar will be there as well in the next couple of days. So you'll be able to see that recording for yourself and share it with your friends, because this is good information. Share it with other business owners, with the employees. Again, good information to share here. And then here's our contact information. I'm gonna also type in Larry's website and also his LinkedIn as well in the in your question box on the right-hand side of your screen. As soon as I can get this to work.
Yeah, so on my LinkedIn, I do a lot of shares when I see a good article about tax issues or something. I usually do a share or a like, because I see a lot of my friends would have good articles posted. So
Okay.
I like to do that. And on my website, larryponcpa.com, you can click on the newsletters tab, and I update that with late breaking news or whatever hot topics there are or whatever. So those are good resources, and take a look at that. You can take a look at my links page. Let me just make a plug for one thing on my links page is if you go to my links page on the left-hand side, there's a tab called scholarships. So if you have high school age or college age children that you know, have them take a look at that. There's a lot of money out there for scholarships that are available. So when people inform me of scholarships, I'll post it there. And,
Perfect. That's great.
yeah, because the money is out there, and all you need to do is apply. If you don't apply, you're not going to get it.
Then you're not going to get it. It's like winning the lottery. If you don't play, you're never going to.
Well, it's not the lottery. The odds are way better than the lottery.
Yeah, the odds are better than the lottery. Yeah, so don't go out and buy too many lottery tickets right away. And I'm having trouble typing it in, so feel free to email me, and I will send you Larry's additional information. His website again, larryponcpa.com. His LinkedIn page is linkedin.com/n/Lawrence Pond. Again, email me or email Larry, and we'll be happy to send those along as well. But again, there's his contact information and mine if you have any questions. I did have a question come in asking, by the way, a good compliment, which is great presentation. So great job, Larry. Will you be sending out the slides and a recording of the program after the event? So yes, so email me, and then I will send out your slide if you're interested in the slides. And again, on that YouTube channel, we will share the recording to the event on our YouTube channel too, so you can share it with friends, family, employees, boss. So we do have another question come in. Okay. Can one easily change from an LLC to another business model, like an S Corp, etc., for improved tax consideration? How easy is that process?
Well, my official answer to that is that it depends.
Okay.
So it depends on how the LLC was formed, where it was formed, and all those kind of things. So,
okay.
So what is an LLC? An LLC is a limited liability company.
Okay.
And in California, it's been around since the mid-90s, I think, or late 90s. So it hasn't been around that long. But if you're an LLC, you can elect to be taxed as a corporation. So there's some elections you can make with the IRS to have that changed. So from a legal format, you can stay as an LLC, but again, like anything else, it's got to be evaluated to see, one, does it make sense to do, and two, are there any obstacles to making that change or decision? So what are some big differences between an LLC and S corporation? In California, one of the biggest differences is that the LLC has what's called an LLC fee. So, so in California, there's an $800 minimum tax that an LLC needs to pay and an S corp needs to pay. But there's also an LLC fee if your gross income is above $250,000. It's an extra $900, and there's a table that shows how much you pay.
Okay. It's
basically gross income, not your net income.
Okay.
Now, this is maybe California. For S corporations, there's also a tax at the state level that's paid by an California S corporation. So there's also thoughts, considerations. Depends on who your shareholders are, your members are. And there's those considerations to think about. So,
okay.
Yeah, there's some careful deliberation before making any changes.
Fair enough.
Yeah.
So another question: as a sole proprietorship, married, filing jointly in the consulting business in the scientific field, to be specific, do I understand correctly that as long as my business income plus spouse's W-2 income with his jobs is under $315,000 after deductions such as mortgage, business expenses, I would qualify for the 20% pass-through deduction for my business income only.
That's correct.
Okay, so that is correct.
So that's a $315,000 threshold.
Okay.
Yeah. So all those limits start applying when your income's above that.
Okay.
Yeah.
Good question. Good
Yeah.
specific question
Now,
too. So thank you for that. Yeah.
On those lists of categories, so consulting is in that category where you're limited.
Yeah.
So if you're not in one of those categories, then it doesn't matter what your income is.
Okay. Good.
Like an architect and an engineer.
Oh, there we go. There we go. I think that's all we have right now, which is good. Very good questions coming in.
Yes.
Again, and I just sent you all the Larry's website and also his LinkedIn page to follow him if you have any questions. Again, expert in the field, has great information, did a really good job today on the presentation. So I learned a lot. And I could still learn a lot more. So another big thing too. So again, and we will have another webinar with Larry probably in July. So just stay tuned to our Skill Builder series. You will all receive that notification as well. We'll put it on our social media and we'll send it in our email blast to our fabulous accredited businesses. But I think that's about it today. Let me check questions one more time before we officially wrap up. Larry, do you have anything else you can think of that you would like to add before we wrap up today?
Planning is important.
I was about to bring that up.
Yeah.
Is planning a good idea?
Yes, it is.
And here's another good comment. Thanks for making complex information more easily understood.
Oh,
great job. Great job. Well, thank you all for attending today. Again, fantastic webinar. A lot of great information. The recorded version is going to be on our YouTube page, so you can soak it in a little more and maybe watch it a couple other times. And because I'll probably need to as well. But it's fantastic stuff. And I hope you all have a fantastic day. Again, Larry, thank you so much for your expertise. And we hope you all have a fabulous day. And stay tuned for our webinar series. Again, Larry will probably join us in July for another edition. So, Larry, thank you again. Thank you all for attending.
Thank you for your time.
And have a great day. Bye, y'all.